Naval just made everyone a venture capitalist with his new company, USVC. And yes, it's exactly what it sounds like. It's a venture capital firm for the public. Yes, this is a real thing. You can now invest in private companies as a part of USVC.com. And we're going to break it down because the focus of USVC seemingly is very, very good. But there are some issues I have with it and why I think it can work and what it needs to change to actually be useful to regular people getting access to startups at the earliest stages of venture capital. So here's my take on USVC. Another bomb just dropped today, not in a bad way, because you can now get exposure to private tech companies. So anyone in the public can get exposure through this company called USVC. I'm not partnered with these guys. I don't know these guys from a hole in the wall, but this new product offering from AngelList. And pretty much the whole thought process is USVC is US venture capital is the way to invest in VC. Start with as little as $500 for broad exposure to private tech companies built by AngelList. So if you go to USVC.com, basically their whole theme and mantra is backing companies building the future before it's obvious. USVC is a new fund by AngelList Asset Management that broadens access to venture capital, allowing retail investors to gain exposure into promising companies before they become well known. So basically you can sign up and you can invest now, and you can invest as much money as you want into USVC and get exposure to a lot of different companies. Right now it looks like they have 7 companies. And the biggest weight, this is actually really cool, but also I have some issues with it from a couple perspectives. From the perspective that this is really cool is that for the most part, you got to understand kind of how gatekept venture has been, because the reason why I make my content, the reason why you see me post on founders, try to help founders out, is because for the most part, if you're like me and you did not go to an Ivy League school and you did not go to like some sort of crazy university, right? You're not being checked for when it comes to raising venture capital. You kind of have to go through some things. That doesn't mean that like, oh my God, like life is just drastically different, but for all intents and purposes, it is a lot harder for someone like me to go raise venture capital without having a network than it would be someone who went to Princeton, Harvard, Yale, Stanford, one of these Ivy League networks that invest in those types of founders. Doesn't mean it's a good or a bad thing. People can invest their money wherever, but for the most part, that has kind of trickled down into investing as well. For the longest time, you needed to be an accredited investor to just even get access to investing in companies. And then good luck trying to find the good ones, but you could even invest in venture without being an accredited investor for a very long time. Still to this case, I think there's like a lot of gray areas and things, but now you don't have to be accredited. Anyone can actively deploy capital into private technology companies. So I think from a overall democratizing venture, I like the idea. But there are two major issues and two major things I have that are wrong with this idea that need to be kind of addressed. And if they're not addressed, then like you're going to see a lot of people lose money. The first one is stage of secondaries. And what I mean by stage of secondaries are when you own shares of a given company. So let's say I invested 25K into OpenAI Series A. I invested 25K into OpenAI Series A. I got in early, pretty much. Now, with that, OpenAI continues to crush it and they're doing really, really well. And eventually OpenAI gets beyond Series A, B, C, D, E, F, G. OpenAI is on the secondaries market, which is where it is right now. So the way secondaries work is every time I have equity at the Series A, every time OpenAI, and I'm gonna make a ladder for this, every time OpenAI raises a new funding round and they raise more money, there are options for investors to sell their shares, right? So let's say I own these shares at Series B and I decided, okay, this is Series G. They did a Series G at a, let's say a crazy valuation. Let's say that's Series G, this is Series D, and this is Series C. When OpenAI goes to raise money at Series C, Series D, Series G, they will reach out to me and say, hey, there are new investors that want to buy your shares at a higher rate. You can sell them. And maybe I'm like, okay, I'll sell my shares. This secondary market already exists. And that's the same thing you're seeing here with USVC. The problem I have with this is who's to say by the time that the secondaries get to you, which is USVC, I don't know yet what rank they're buying at, but who's to say they're not offering secondaries at a price that would be potentially lower than the IPO, right? And when they say like, okay, like we get into these companies early, back the companies building the future before it's obvious. But then you look at like all the companies that are in the current USVC, to me, this is a bunch of obvious companies. Lagora's a $10 billion plus company, I'm pretty sure. OpenAI billions, Vercel billions, Anthropic billions, XAI billions. All these are, I think they're all multi-billion-dollar companies, which from one perspective, yes, you want investors to be safe, right? You want them to be safe, but this isn't the US stock market, right? I don't want to invest in secondaries at USVC. And then if OpenAI IPOs and flops, like Figma's a $10 billion company. At the height, if we look at like Figma from like a year, it was $100 a share, $122 a share. Figma's down 84% in the past 5 years. I mean, well, not in the past 5 years, it just IPO'd last year. It's down 85% in a year. The buy option, the best time to buy was here, not here. But my point in saying this is if you're trying to tell somebody they should be buying secondaries in OpenAI, if these secondaries are at $1 trillion valuation, to get secondaries in USVC at $1 trillion valuation, and then OpenAI IPOs, and you look at OpenAI post IPO and it does a Figma or even does a 50% down, like what value was it to get exposure to these public markets if you didn't get exposure early enough? So my biggest criticism with this is like, for this to be effectively good at a point where there is a good level of like, yes, in venture, your risk capital is a thing. If I'm investing in a venture fund, I know that my funds could potentially go belly up, but I don't want to invest at trillions of dollars in valuation. I want to get into the Series A's, the Series B's, the Series C's, the rounds that have potential upside and downside because the upside could be higher. Right now, when I look at a company like Crusoe and I'm like, okay, what did Crusoe raise their last funding round? Their last funding round was at a $10 billion valuation. Let's say, okay, they're a decacorn. Let's go look at XAI because most of the portfolio is XAI. XAI's last valuation was 230 to 250 billion. That's just for XAI. If it's true that they're going to merge with SpaceX and then do one big kind of smorgasbord round, if they're worth 250 billion, what is SpaceX worth? SpaceX is, I don't know how much of this, estimated around 500. So you're already at 175. It's like the upside only exists if public investors, when this gets to the public market, believe that there is still a price to go up. If SpaceX eats XAI, which will probably happen, or X, and then they go public at a 1.7 trillion valuation, as they're saying, you're not really getting a bunch of crazy multiples at that point, at least not initially. So for me, I look at this and I'm like, okay, the concept is really good, but they need to get companies that are not already at a $10 billion valuation, right? Like I want to see them go out and bring in companies to this portfolio that like are net new and different, that are raising somewhere within that 100 to 300 to $500 million range. Maybe that's too, maybe like they can't get around certain regulatory approvals for that. But from my perspective, when I think about like what makes this interesting is it's not buying secondaries of companies like Anthropic, right? Like transparently, I literally got an email the other day. I got an email about Anthropic secondaries. Excited to invest in Anthropic secondaries at a valuation lower than the current secondaries market of a 1 trillion plus. So instead of getting it at 1 trillion, what am I getting at? 800 million? So if investors are trying to sell Anthropic secondaries lower than the current cost of what they think the valuation is, why are they trying to sell cheaper than the real valuation? Do they not think that Anthropic, when it IPOs, will be worth more than like what it is now, right? So now you're starting to see what I'm saying, where it's like, what happens if you're getting secondaries that are going to be like lower than where they IPO? I personally don't want to invest in a company. I don't want to put my money in that. So I think this is a great idea. I think it's a great way for venture capital to be open to the public. But the biggest thing is like, I would want to see them go out and bring in some more high risk, interesting companies before I start throwing my money in all willy nilly. And then two, at the end of the day, dude, they're going to make a bag. They're GPing this, meaning they're going to get 20% of all capital, right? Like you get a 20% management fee, and then you're getting 20% of any returns by creating an open VC portfolio for the world. They're going to get an absolute insane bag. So I like the idea. I would love to chat with the founder. There's two founders, I'm sure I won't chat with Naval, but the other founder, to be able to just kind of talk more about like where they see this sort of thing going, and then like how they combat against some of these things. Like how do you combat against like secondary markets being lower, and some of these companies going public lower than at what you invested in the rate at? Because if you really want to get people into venture capital, I would rather my $500 be put into a company that could die in 6 months or be worth billions than to put it into a company like SpaceX, where it's like, bro, if you invest $500 into SpaceX right now, the best thing you can hope for in the short to intermediary is like a 2 to 3x, right? That's not really that great for the general public when you're trying to like make money. So that's my thoughts on USVC. I think it's a very interesting concept. I just think that like I need to see more non-obvious companies. You can't say the copy can't be back the companies building the future before it's obvious, when I think it's very obvious that XAI is a winner. It's very obvious that Anthropic is a winner. It's very obvious that OpenAI is a winner. So just my thoughts. Feel free to share yours.